Okay, let's crack open something truly groundbreaking today. Imagine a future where the rigid lines of traditional finance kind of melt away.
Yeah, a future where almost any asset you can think of.
Right, like a multi-million-dollar bond or even a tiny piece of fine art.
Exactly.
Sure.
Can live and be traded on a blockchain.
That's the fascinating realm we're exploring, real-world asset, or RWA tokenization. We've pulled together an incredible stack of insights for you, drawing from heavy hitters like the World Economic Forum, KPMG, PwC, and the CFA Institute to guide us.
And what's genuinely captivating here, I think, is that this isn't just a tech upgrade. It's more fundamental.
How so?
It's really a reimagining of what value is, how we own it, how it moves around. So our mission today is to, cut through all the jargon and really shine a light on how these traditional assets are getting this complete digital makeover. We'll unpack the core mechanics, look at the maybe surprising advantages, dive into some real-world applications happening now, and then, importantly, take an honest look at the hurdles.
Right.
Because there definitely are some in this rapidly evolving space.
Right. Understanding the what, but also the why behind it for finance.
Nicely.
So to really get a grip on this, we need to start with the basics. What exactly is RWA tokenization at its core?
Well, the CFA Institute and the Financial Stability Board offer some pretty clear definitions. One way to think about it is the act of creating a digital representation of various assets using distributed ledger technology. Simple enough, right?
Or I saw another one, the process of recording claims on real or financial assets that exist on a traditional ledger onto a programmable platform.
Exactly. So essentially giving something tangible or traditional a kind of digital twin on a blockchain.
A digital twin. I like that.
And these twins, these tokens, they're more than just digital placeholders. They're quite sophisticated. They're designed to actually embed the asset's definition and the rules governing its transfer right into the digital representation.
So you're not just moving a receipt, you're moving the asset's logic too.
Yeah, got it. The underlying records, the logic for how it can be used or traded, all bundled together. Now, when we talk about these distributed ledgers, DLTs, there's quite a spectrum.
Right. It's not just one thing.
No. Think of it like a scale.
Yeah.
On one end, you've got totally open public networks, Ethereum, Bitcoin, anyone can join.
Okay.
On the other end, highly controlled private ledgers. Often used by banks, access is restricted, permissioned.
And those choices matter.
Absolutely. These design choices profoundly impact security, privacy, speed, how your tokenized asset is managed and transacted. It's definitely not one size fits all.
That makes a lot of sense. And something I found really interesting in the sources is that it's not an all or nothing deal, right?
Exactly. We're seeing a lot of these hybrid models popping up.
So you don't have to tokenize the entire thing from start to finish.
No, not at all. Companies are figuring out where the digital approach adds the most value to the tangible asset, tokenizing specific parts of the value chain.
It's much more flexible than I first thought. Okay, so why is this happening now? What's the real game changer here beyond the tech?
The core question. This is where it gets really interesting.
Yeah.
The World Economic Forum really lays out the value proposition well. The first big one, and maybe the most transformative, is expanded market accessibility.
Accessibility? How?
Through micro units of ownership.
Yeah.
Think about private markets, high-end real estate, private equity, fine art, historically very exclusive.
You need deep pockets, institutional investors, high net worth individuals.
Exactly, because of hefty minimum investments. I mean, the average global sale price for fine art in 2022 was over $43,000.
Wow.
Tokenization flips that script. Through fractionalization, breaking assets into smaller pieces, it drastically lowers administrative burdens and entry barriers.
So more people can get involved?
A much wider range of investors. Suddenly, you could potentially own a tiny piece of that multi-million-dollar painting or a fraction of a commercial building with much less capital.
That truly democratizes access to assets that were, well, completely out of reach before, and maybe shorter lockup periods too.
Potentially, yes. It opens things up significantly.
Incredible. So theoretically, my meager savings could finally get me a digital sliver of a Monet. My art collection expands beyond fridge magnets.
Well, theoretically, yes, that's the vision.
But I do wonder, if you fractionalize something traditionally illiquid, Does that create a false sense of liquidity if the secondary markets aren't quite there yet?
That's a really critical point, and yet we'll definitely come back to secondary market liquidity as a major challenge. It's a big one.
Okay.
But staying on the benefit side for a moment, another powerful concept is composability.
Composability.
Yeah, the ability to easily package and repackage system components and transfer these digital assets across different platforms. Think multi-chain, multi-asset operations.
Like digital Lego bricks.
That's a great analogy. Assets become like Lego bricks. You can quickly reassemble and reuse across different trades and systems. This really improves collateral mobility and could boost liquidity.
Interesting. What else?
Then there's programmability and operational efficiency. This is where smart contracts really come into play.
Right, the automated agreements.
Exactly. They automate complex financial stuff. Dividend distributions, managing cap tables, even bookkeeping, embedding the logic right into the process. Huge efficiency gains, less human error.
Makes sense.
And finally, there's direct user control. You hold the private keys to your digital assets, giving you autonomy.
But that comes with risk, right? Lose your keys.
Absolutely. The flip side is the huge risk of losing or compromising those keys. So robust security is completely non-negotiable.
Okay, so accessibility, composability, efficiency, control. Powerful stuff. But for listeners trying to, wrap their heads around this, what kinds of assets are we actually talking about? Where is this happening today?
Great question. We're seeing some really impressive figures and real-world use cases already. Take fixed income, especially bonds. Huge area.
How big?
The global bond market was around $140.7 trillion in 2023, and a survey found 65% of financial institutions think bonds are the most likely asset to be tokenized.
65%? Wow. Any example?
Oh, yeah. The European Investment Bank, the EIB, they've issued bonds on-chain. Societe Generale 4G has done tokenized corporate bonds. And Switzerland's SDX, the CX digital exchange, announced back in May 2024 they'd cleared over $1 billion Swiss francs, about $1.2 billion in tokenized municipal bonds.
$1 billion.
And by November 2024, total tokenized fixed income, including things like US Treasuries, had already passed $2.5 billion in value. It's moving.
Okay, bonds make sense. What else?
The gold-backed tokens are another area gaining traction. Market cap was about $1.62 billion last November.
Gold tokens, what's the appeal?
Well, they offer continuous 24/7 trading, which is a big deal compared to traditional markets.
But challenges too.
Definitely. Potential price differences when interacting with conventional Monday to Friday markets.
Right.
And physical redemption can sometimes be tricky.
Right.
Carbon credits are also fascinating. Tokenization here really democratizes access. Individuals, smaller organizations can participate in carbon offset initiatives. It broadens the market reach.
And the smart contracts help there too.
Big time. Automating transactions, ensuring compliance, boosting market efficiency.
Okay. What about things like repos?
Repurchase agreements, yeah. Intraday repo seems to be a primary adoption area. JP Morgan's Connexes platform is a good example.
Connexes?
Oh.
What's special about it?
It uses a private permission blockchain quorum specifically designed for institutional needs like performance, privacy, security in payments and settlements.
Gotcha. And investment funds.
Yep, investment funds too. Big names like Hamilton Lane, Franklin Templeton, Generali Group are exploring tokenizing their investor registers. And platforms like Securitize are tokenizing the fund layer itself. The share is not necessarily the underlying assets in the portfolio.
What does that achieve?
It streamlines private fund investments. Things like collecting total commitments up front, potentially shorter lockup periods, and crucially, enabling secondary market trading after maybe 12 months.
That's a phenomenal range. Bonds, gold, carbon credits, repos, funds. The numbers are really eye-opening.
They really are.
It makes you think how this could transform everything from how you, the listener, invest to how businesses raise capital. It's not just faster processes.
No, it's fundamentally altering market structures.
Yeah.
And speaking of structures, that synergy between primary issuance and secondary markets for RWA tokens is absolutely critical.
Why is it so important?
Because it unlocks substantial additional value compared to just sticking with paper. A platform like IXSwap, for instance, pioneered the world's first automated market maker, an AMM just for RWA tokens.
An AMM for RWAs, what does that do?
It basically allows anyone holding these tokens to start a liquidity pool. This means 2047 trading is possible without needing a specific buyer or seller present at that exact moment.
Continuous trading, okay.
And having that robust secondary market significantly reduces the illiquidity discount.
Where assets are cheaper just because they're hard to sell quickly.
Exactly. Making RWA tokens more attractive, bringing more people into the market.
It's interesting, though, seeing the different reactions from traditional finance players. Our sources suggest most stock exchanges are still doing, well, nothing much.
It's true, surprisingly perhaps, but others are really leaning in.
Like who?
Singapore is a standout leader. They've got about a dozen token exchanges, including big ones like DBS Digital Exchange. Switzerland hosts maybe half a dozen.
So why the difference? Why are some moving and others watching?
Well, the ones moving see huge opportunities, especially in private capital. That whole sector often uses pretty outdated infrastructure, lots of paper, manual processes.
Right, very inefficient.
So exchanges see a chance to help private equity firms communicate better, automate investor servicing, manage cap tables more easily.
And reach more investors.
Precisely. By tokenizing funds and securities, they can dramatically widen the net for the private equity industry. SDX in Switzerland, working with platforms like Dora and Equitech, is a good example digitizing shareholder registers for private companies.
They're building the digital plumbing for private markets, essentially.
That's a perfect way to put it.
So what does this all mean for that existing plumbing, the traditional intermediaries? Are they being replaced?
It's more an evolution, I'd say. Central counterparties, CCPs, the clearinghouses, they might become more governance-focused, managing tokenized collateral,
Right.
cross-chain stuff.
Okay. And CSDs, the depositories.
Central securities depositories could start issuing assets with native digital IDs, automating servicing, maybe even handling settlement directly with on-chain cash. And of course, we're seeing new specialized players emerge, digital asset custodians, specialized exchanges, bridging that gap between TradFi and these new programmable assets.
Less replacement, more redefinition of roles.
I think that's right.
It sounds like an exciting new world, but let's be real, it's not all smooth sailing. What are the major hurdles, the roadblocks we need to tackle for RWA tokenization to really go mainstream?
Absolutely. Every revolution has its challenges. The World Economic Forum points out several big ones. First, just integrating this new tech into legacy infrastructure.
Fitting new tech into old systems sounds hard.
It is, like putting a rocket engine in a horse carriage, as they say. Then there's the issue of inconsistent global standards and interoperability.
Different rules everywhere and blockchains that don't talk to each other.
Exactly. A lack of uniformity across borders, limited cross-chain functionality. This leads to fragmentation risks.
Meaning?
Individual private blockchains might not be economically viable on their own, leading to isolated assets. It really highlights the need for consortiums or much better interoperability, like banks sharing one ledger for repos instead of each having their own silo.
That makes sense. What else?
Well, circling back to your earlier point, inadequate secondary market liquidity. This is a big one.
Still a problem then?
Yes. Even with over $15 billion in tokenized fixed income issued by 2024, almost half reported low turnover. That means illiquidity, problems pricing assets accurately. Issuing is one thing, creating a liquid market is another beast entirely.
Right.
Cybersecurity is, of course, paramount.
Yeah.
And it's not just about lost private keys, which is what gets headlines. Many crypto breaches actually stem from conventional threats.
So standard security hygiene still applies.
Absolutely. Harmonized measures with traditional finance, strong threat modeling, advanced key management, all crucial.
Okay.
Then there's financial stability. Tokenization offers amazing tech programmability, instant settlement, 247 markets.
But there's a but.
Yeah. Some critical operations like risk management and clearing still need controlled windows for stability. It's a balancing act between innovation and operational reality.
I see. Privacy too.
Privacy and data concerns, definitely. Things like GDPR's right to be forgotten. How does that work with data on an immutable blockchain? Plus the challenge of developing quantum-safe privacy tech for the future.
Quantum computing. Another layer of complexity.
And finally, what some call the unresolved issuer problem. It's this fundamental clash between existing financial regulations, which focus on specific entities, and the decentralized nature of digital finance that often aims to remove intermediaries.
A legal and conceptual puzzle.
Well, very much so.
That's a comprehensive and, bit daunting list of challenges. So, given all that, how are regulators globally actually responding? What's the pulse?
It's definitely evolving fast. The PwC report calls it a bit of a patchwork quilt right now.
Okay.
In the US, we're seeing a shift in 2025, moving towards a more, let's say, crypto-friendly stance, away from just regulation by enforcement, trying to get clearer rules out there.
A dedicated working group too?
Yeah, a digital asset working group trying to foster innovation but also maintain oversight. And tokenized RWAs seem to be gaining traction there as clarity improves around asset-backed digital securities.
What about Europe?
Europe took a big step with micro markets in crypto assets regulation, fully operational in December 2024.
MiCAR, what does it cover?
It sets up a pan-EU system for crypto assets that aren't financial instruments. Think stablecoins, utility tokens. It requires authorization for service providers, sets up rules against market abuse. It's pretty comprehensive.
And the UK.
The UK is also moving forward with its own extensive framework, notably bringing stablecoin activities into the regulated financial services fold.
So individual jurisdictions are moving, but what about globally?
Global bodies like FATF, the Financial Action Task Force, and IOSCO, the Securities Regulators Organization, are pushing hard for a same risk, same rule approach for DeFi.
Applying existing principles to the new tech.
Essentially, yes. And they're calling for better data, better understanding, and much more cross-border information sharing on tokenization. Because this stuff doesn't stop at borders.
It really underscores that CFA Institute view, doesn't it? The need for balance, championing innovation, but ensuring robust consumer protection.
Absolutely.
And that international standardization seems crucial for this to really scale globally.
Imperative, I'd say.
So, given everything we've discussed, the potential, the current uses, the very real challenges, what does the near future look like for RWA tokenization? Where is this heading?
We're seeing a few key areas of convergence emerge. First, as we just talked about, regulatory clarity is the absolute catalyst.
Everyone's waiting for the rules.
Pretty much. 79% of institutions surveyed said clarity is the key dependency for on-chain cash to scale. Interestingly, too, 59% prefer wholesale CBDCs, central bank digital currencies, for DLT-based debt issuance.
So a preference for official digital settlement assets.
It seems so. Second, the continued rise of stablecoins. It's undeniable.
They're huge already.
Over $240 billion market value. KPMG sees them becoming a foundational pillar for next-gen payments and banking. Their growth is fueling institutional adoption and pushing legislators to act faster.
Right. And anything else on the horizon?
One truly futuristic area is the convergence of AI and blockchain.
AI and blockchain, how do they fit together?
Imagine AI agents interacting directly with crypto protocols, automating complex financial workflows, making dynamic decisions right on chain. It could lead to completely new levels of efficiency and autonomy in DeFi.
Wow.
Blockchain's trustless nature could provide the secure rails for these AI transactions. And think about deepfakes.
Yeah, getting harder to spot.
Blockchain-based decentralized identity might become vital just to prove who's human and who's an AI in financial interactions.
Mind-bending possibilities there.
You really are.
Well, what an incredible journey through the world of real-world asset tokenization. From getting the definition straight, exploring benefits like democratizing investment, to looking at the actual assets being tokenized, the infrastructure needed.
Right, and then digging into those significant roadblocks and the evolving regulatory map that's trying to guide it all.
And if we just connect this to the bigger picture for a moment, you can really see how this isn't just niche tech. It's about redefining how we perceive, own, and transfer value in an increasingly digital world.
Understanding this isn't just about isolated facts. It's about grasping a key part of the huge transformation happening in global finance.
So the final thought for you, our listener, what does this all mean for your future, and what's the one thing that truly stands out to you about this incredible transformation?